With more on how to position portfolios joining us today on set, we're pleased to have Charles Schwab's Lizanne Sonders and Credit Suisse's Jonathan Golub. Good to see you guys both here. Great to see you. All right, so what's important today? Is it about what he says about the future and higher for longer, or overwhelmingly important mandates? What?
I wouldn't be surprised if the formality of the statement mirrors to some degree what he said at Jackson Hole, but of course there was no Q&A after Jackson Hole. So I think probably that part of the meeting will be focused on how long is it going to take to get to your destination, but maybe even more important, how long are you going to stay at the destination? And that's what he's been pushing back on, this idea that they're going to kind of go for a quick visit and then turn around. And even though the market has raised the end point, it still has an expectation that there'll be a pivot fairly soon after that. And I think he'll probably reinforce, once we get there, we're going to stay there for a while.
Do you think that's right, that participants are going to be like, don't get all hooked on the idea that there'll be multiple cuts next year?
Well, I think there's two things, and I agree with Lizanne. The first thing is it's about the terminal rate. How high are they going to go, and how long might it take them to get there? I would expect that the 75 basis points seems to be baked in. So assuming they do that, there's no story. But I also think that you're going to see a 50 basis point increase in their statement on how far they're going to have to take this process. The market's already predicting that. So that's really going to tell you a lot more about the broader process. And what they're going to try to do, and it's exactly to your point, is to get the market to not think that the second they get to that point, they're going to immediately start easing. I do think the Fed is going to pause sometime in the, let's call it the second quarter, whatever, because the things they're doing now are not meant to affect inflation today. They're meant to affect inflation at the end of 23 or even into 24, and they need to give the market some time or the economy some time to react to it. So I think they're going to push really hard, probably through the end of the first quarter. They're going to pause, most likely to let things materialize in front of them. And my guess is they're going to probably have to push further beyond that later on. But I think the market is probably going to respond really well to them saying, we're just going to take our breath and watch things come in. The market may overreact as a positive, response to that.
You think that's true? We're conditioned for that moment, Lizanne?
Well, I'm not sure that the market as an entity still understands that there's a big difference between pause and a pivot. And I think that's likely what the Fed is going to reinforce today, staying there for a while. I do think at some point the Fed will be able to take a breather just to assess. The issue, though, is that the Fed is taking its cue from lagging indicators, and the effects of what they do are in the future. So there's these lead-lag issues that I think make it a bit of a disconnect, and it's a tough needle to thread what they're trying to do here.
Jonathan, to bring it back to the stock market, I'm always curious as to, strategists like yourself, Lizanne, what you hear from clients, because I talk to a lot of asset managers during the course of doing my job. They're all over the place, but I would say largely negative, still very concerned about earnings coming down dramatically in this quarter and into the next quarter, and don't seem particularly willing to step up in a big way to put risk on. That said, there may be some stock picking that can work. What are you hearing?
Yeah, David, so yesterday evening after the close, we had a meeting and we do this regularly, with 9 guys who are either the head trader, CIO, hedge fund founder, and we just get, people just share ideas and the like, and there wasn't a single one who was anything but negative. The guys who were positive said, all right, I don't think the market necessarily falls apart. I just don't see anything that I want to invest in. And there was a lot more talk about credit as an alternative to equities than I would have normally.
So how do you push back at all on that? Do you sort of introduce something a little more positive in terms of at least where we are in revisions, for example, on estimates?
Well, and a lot of this is me trying to kind of navigate personalities. But there was a couple of positive signs. First of all, the tech earnings look much worse than anything else, and that's a bit of a concern. But they're expected to come back next year and get stronger. And the energy, which is holding up unbelievably well because of refining margins, look like that's going to fade, and they're going to be a drag on market earnings next year. So it looks like, from an earnings perspective, there's a lot of movement underlying something which we think about as a general number.